Hello everyone, welcome to the session. By now, one reality should be clear. For most organizations, Scope 3 emissions dominate the carbon footprint, often accounting for more than 90% of the total emissions. Yet, Scope 3 is also the least mature, least reliable and most debated part of the GHG account because Scope 3 emissions do not sit nearly inside the organizational boundary. They span suppliers, logistics partners, customers and end-of-life systems, many of whom do not measure the emissions or do not share the data, or they do not see emissions reporting as their responsibility. In this session, we focus on the practical organizational challenges faced while accounting for Scope 3 emissions across both upstream and downstream value chain. Scope 3 emissions are divided into upstream and downstream activities to reflect the full value chain. Upstream emissions occur before the product reaches the organization, such as raw materials, packaging, capital goods, inbound transport, and supplier operations. Downstream emissions occur after the product leaves the organization, distribution of the product use, and end-of-life treatment. While the classification is conceptually clean, in practice, it introduces data fragmentation, ownership gaps, and significant uncertainty. The most common challenge in Scope 3 accounting is the lack of reliability. Most suppliers, particularly the MSMEs, do not measure or track their greenhouse gases. Even when data exists, it may not be product specific. Methodologies may differ and emission factors may not be transparent. Reporting cycles may not align. As a result, organizations rely heavily on spend-based emission factors, industry averages, and regional proxy data. This is not a weakness, it is a starting point. Scope 3 accounting is about building accuracy over time, not achieving perfection in the first place. Consider a mid-size FMCG company sourcing corrugated packaging from 40 suppliers. Out of these, only 5 suppliers provide emissions data. The remaining 35 are MSMEs without carbon accounting systems. The company spends 8 crores annually on packaging. Using industry average emissions factor of 2.4 tons CO2 equivalent per 1 lakh, estimated emissions as 1,920 tons of CO2 equivalent. If a large supplier uses renewable energy, actually emissions may be lower. But without primary data, this improvement cannot be reflected. This illustrates why early Scope 3 inventories are conservative by design. For MSMEs, GHG accounting is not just a data challenge. In response to Scope 3 data requests, an MSME may need to hire consultants or auditors, allocate staff time to data collection, purchase metering or software tools, learn unfair reporting frameworks. As a result, emissions reporting is often deprioritized, data requests go unanswered, and the suppliers perceive sustainability as a compliance burden rather than a business opportunity. This cost burden explains much of the non-responsive seen in supply chain. Low response rates are the structural issue in Scope 3 accounting. Suppliers may lack awareness of emissions terminology, be concerned about some confidentiality, fear commercial disadvantage, see no immediate value in participation. This results in partial coverage and inconsistent data set. Particularly in the early years, organizations may accept that Scope 3 reporting improves through engagement and trust, not pressure. Most organizations have visibility only to Tier 1 suppliers. However, emissions often originate in Tier 2 and Tier 3, such as raw material extraction and energy-intensive process. For example, packaging emissions may appear modest at the converter level, while the majority occur during pulp production or the resin manufacturing upstream. Geographic dispersion, command sensitivity, and the lack of traceability make full supply chain mapping a long-term effort. Downstream emissions introduce a different challenge: customer behavior. How efficiently customers use the product, how long products remain in use, how they are disposed of at the end of. Assume FMCG company sells 1 million packaged foods units annually. If each unit requires 0.4 kg CO2 equivalent for cooking or refrigeration during use, amounts to a total of 400 tons of CO2 equivalent. If 60% of packaging goes to the landfill, with an average emissions factor of 0.2 kg CO2 equivalent per unit. The total GHG would amount to 120 tons of CO2 equivalent. Total downstream emissions from just these two assumptions would amount to 520 tons of CO2 equivalent. These emissions are influenced not by ownership but by product design, packaging choices, and consumer guidance. Scope 3 accounting is not just about eliminating uncertainty. It's about using the credible proxies, document assumptions, applying consistent methodologies, and improving data quality over time. All the challenges discussed, data caps, MSMEs, cost burdens, supplier unresponsiveness, and downstream uncertainty led to one core question: who owns Scope 3 data, and how do organizations enable others to contribute? In the next session, we will focus on data ownership and stakeholder management, how organizations align responsibility, collaboration with suppliers, build internal accountability, and manage change effectively. Because Scope 3 success is not achieved through control, it is achieved through shared responsibility and structured engagement. Thank you for watching and stay tuned for more such updates from ReGeneva.